Welcome to the deep dive. Today we're plunging into, well, a bit of a paradox shaping the US economy right now here in July 2025. On the surface, things look, remarkably stable. Unemployment's low, inflation's hovering right around the Fed's 2% target. But if you dig just a little deeper beneath that calm exterior, you start to see these pretty profound structural cracks widening. Our mission today is to really unpack a critical, in-depth report looking at the US market outlook. We're going to explore why the Federal Reserve current policy stance might be, well, fundamentally misaligned with the actual economic reality. It's almost as if the Fed is waging a war against the ghost of past inflation, using tools that just seem ill-suited for the challenges we face right now. And the risk, significant and maybe crucially unnecessary economic downturn.
And to truly make sense of these contradictory signals, we're going to introduce a powerful new analytical lens. It's this idea of maintenance versus growth spending in the economy. This distinction, I think, will be key to understanding not just what is happening, but why a major policy pivot might be crucial right now. It's a way to cut through the noise, really.
Okay, so let's start by quickly re-anchoring on the basics. Maybe just remind us, what exactly is monetary policy and what's the Fed's crucial dual mandate?
Right. So in essence, monetary policy is how the U.S. Federal Reserve tries to steer the economy. They have two main goals: promoting maximum employment and keeping prices stable. Their primary tool for this is the federal funds rate. That's basically the target interest rate banks charge each other for overnight loans. Changes in that rate then ripple throughout the entire financial system, affecting everything from, your mortgage rate to what a company pays to borrow money for expansion.
And how do they actually control that rate? It sounds a bit abstract.
Well, think of the federal funds rate as the main steering wheel. But the Fed also has smaller, more tactical controls. Things like the interest on reserve balances, or IORB and overnight reverse repurchase agreements, the on-RRP facility. These are kind of like setting guardrails on a highway, making sure short-term interest rates don't veer too far off the intended path, keeping them within the target range they set.
What's fascinating here, though, is that as of July 2025, the Federal Open Market Committee, the FOMC, seems to be at a real impasse. Despite inflation clearly cooling and, nudging closer to that 2% target, the committee has held the federal funds rate in a pretty restrictive range, 4.25% to 4.5%. Why the long pause?
Yeah, the official rationale from the Fed has been a wait-and-see approach. They've said they want to see a broader set of inflation readings come down, and they're closely monitoring the labor market, citing some uncertainty from recent, maybe isolated price spikes. It's this data-dependent stance. What's probably also at play, though not explicitly stated, is a complex political and media environment. Any policy move, especially a rate cut, carries significant political risk, frankly. And that can, unfortunately, incentivize inaction.
It certainly feels like a delicate dance, but there's a prominent voice within the Fed itself challenging this inertia. Federal Reserve Governor Christopher Waller. He's been making a very clear case for an immediate rate cut, right? A 25 basis point cut at the next meeting. What's the core of his argument? What makes his view so different?
Waller's argument really rests on three main pillars. First, he argues the Fed should look through the inflationary effects of the recent tariffs. He sees these as, quote, one-off increases in the price level, not some persistent inflationary trend that monetary policy should be fighting.
Okay, look through tariffs. That sounds bold. Is that standard practice? Just ignore a price increase.
Actually, yes. Standard central banking practice, especially when longer-term inflation expectations are well anchored like they are now, is to disregard such temporary supply-side price effects. Waller's essentially advocating for a return to that established principle. It's not really radical from that perspective. His second pillar is that current monetary policy is simply too restrictive. Think of the neutral rate. That's the rate where policy is neither speeding up nor slowing down the economy. Our report suggests the neutral rate is around 3%. But right now, the Fed funds rate is 4.25 to 4.5%. That's a full 1.25 to 1.50 percentage points above neutral. With real GDP growth estimated at a pretty soft 1% in the first half of 2025, and unemployment at 4.1%, which is near its long-run potential policy, is actively constraining an economy that doesn't really need constraining anymore, especially with headline inflation also near 2% if you exclude those temporary tariff effects. And finally, and this seems quite urgent in his view, Waller points to increasing downside risks in the labor market. While the headline numbers might look stable, he warns that private sector payroll growth is already near stall speed, particularly once you factor in expected data revisions. So he argues the Fed should act preemptively, cut rates before the labor market visibly deteriorates. Given that the upside risks to inflation seem limited now, waiting for a definitive breakdown in jobs would be, in his words, a costly policy error.
So This isn't just a simple debate about when to cut rates. It sounds like a fundamental internal debate within the Fed itself. Waller's proactive risk management approach versus maybe the FOMC's more reactive, lagging, indicator-based stance. It's really about the methodology of how policy should work in an economy facing these, well, novel shocks and structural changes. Okay, so to really understand what's happening, we need to unpack this idea of an inflation mirage. What does that mean for you, the listener? Well, the headline inflation figures, while they are approaching the Fed's 2% target, seem to be propped up by forces that are largely immune to higher interest rates. It's like an illusion that monetary policy just isn't equipped to solve.
Right. So just to clarify, we track prices using metrics like the Consumer Price Index, the CPI, that's what consumers pay, and the Producer Price Index, PPI prices producers get. And to see underlying trends, we often look at core inflation, which strips out volatile food and energy. As of July 2025, headline CPI is around 2.7%, core CPI is a bit higher, about 2.9%. Meanwhile, the upstream headline PPI is actually cooler, roughly 2.3%. That suggests producer price pressures are pretty contained. So the critical question is, what's keeping core CPI stubbornly, well, elevated?
And the report we're looking at points to two specific culprits driving the remaining inflation, those tariffs we mentioned and healthcare costs. And here's the crucial part. Both are seen as structural or one-off issues, not the kind of demand-driven inflation that the Fed's interest rate tools can really target effectively.
It's exactly. Tariffs, for example, function as a one-time price shock, not a source of persistent compounding inflation. A tariff is basically a government tax on imported goods. It causes a step up in the price level of those goods, sure, but it doesn't create an ongoing inflationary spiral. As Governor Waller explicitly stated, central banks should generally look through these kinds of temporary price level effects. Then you have healthcare costs. This represents what we're calling maintenance inflation. This funding is a structural feature of the economy. It's necessary, largely non-discretionary, and pretty insensitive to interest rates. You don't put off essential healthcare because rates are high. And there's a hidden snag here. The way the Bureau of Labor Statistics, the BLS, measures health insurance costs of the CPI is, well, it's kind of wonky. It's an indirect method based on the profits insurance companies retain, not what you actually pay in premiums or out of pocket. This creates huge lags in volatility and often doesn't reflect real-world healthcare costs, making it a potentially unreliable signal for the Fed to base policy on. So if we connect this to the bigger picture, it really seems like the Fed's policy is being held hostage by these statistical quirks and supply-side shocks that are fundamentally outside its control. Monetary policy works mainly by influencing aggregate demand. But these two key drivers, tariffs and this measured healthcare inflation, they aren't really demand-driven. Raising interest rates to combat them is kind of like a household deciding to cut its own salary because the government raised its taxes. It inflicts pain without fixing the root cause. It punishes the interest rate-sensitive parts of the economy like housing, business investment for the sins of trade policy, or structural healthcare issues. This right here is the great disconnect in action for you.
Right. Just to give you a clearer picture of that inflation story in July 2025. Headline CPI about 2.7% year over year, driven mainly by those one-off tariffs and structural healthcare costs, the maintenance inflation. Core CPI, excluding food and energy, is a bit higher, around 2.9%. That's dominated by shelter and other core services, including that strange health insurance measure, which kind of masks some goods deflation happening elsewhere. And importantly, upstream prices from producers. They're actually cooling. Headline PPI is down at 2.3%, suggesting input costs are contained. So the problem isn't broad demand, it seems to be these specific supply-side elements. Let's dig a bit deeper into this with that powerful analogy you mentioned from corporate finance, the difference between growth capital expenditures and maintenance capital expenditures. You said it offers a really useful lens for understanding how the U.S. economy seems to be splitting in two right now.
Yeah, in business, capital expenditures, or CapEx, are just funds used to acquire, upgrade, or maintain assets. Pretty simple. But there's a crucial difference. Growth CapEx is discretionary spending. It's aimed at expanding a company's productive capacity, building a new factory, entering new markets. It's the engine of expansion, the spark for new jobs and innovation. Maintenance CapEx, on the other hand, is the necessary, often non-discretionary spending just to sustain current operations, repairing machinery, replacing old computers. It keeps the business running, but it doesn't generate new growth. And the balance between these two, it's a critical indicator of a company's health and future prospects.
Okay, so how does this corporate finance idea apply when we scale it up to the whole U.S. economy? How does it help diagnose the big picture?
Well, if we connect the dots, it becomes pretty clear. The persistent rise in healthcare spending we discussed, as it gets measured in the CPI. That's analogous to national maintenance CapEx. It's a necessary, enormous cost just to maintain the population's health, our human capital. But while it's essential, this spending doesn't really expand the economy's productive frontier, and it's largely insensitive to interest rates. Similarly, think about it this way. A homeowner repairing a leaky roof, that's maintenance. Adding a new room, that's growth capex. A business replacing old servers is maintenance. But a business investing in a new AI platform to revolutionize its logistics, that's pure growth. And in our current high-rate environment, those growth-oriented activities are the ones being choked off, while the maintenance activities just have to persist out of necessity. What's truly fascinating here is that this framework seems to resolve those conflicting economic signals we started with. The puzzle, how can the economy be slowing significantly while headline job and inflation numbers stay firm? It's explained by this split. The economy isn't one single thing. It's operating on two distinct circuits, you could say. The maintenance circuit. Healthcare, government services, essential repairs. It's large, relatively inelastic to interest rates, and it's propping up the headline stats right now. Then there's the growth circuit. New home construction, business expansion, tech investment, durable goods purchases. This part is highly sensitive to rates and future expectations. And here's the crucial point for you. The Federal Reserve's single, blunt policy tool, high interest rates, is disproportionately harming the growth circuit. It's actively slowing the very activities that lead to future productivity, innovation, and wealth creation. Meanwhile, the maintenance circuit just kind of chugs along, generating inelastic, maybe non-productive inflation that the Fed's tools just can't really touch effectively. This explains why GDP growth is so anemic, even while some sectors report strong job growth. The quality and type of economic activity matter far more than just the headline quantity.
Okay, just to quickly recap that for you. Think growth capex on one side, expanding output, productive jobs, long-term GDP. Examples: AI investment, new homes, business expansion, buying durable goods. Highly sensitive to interest rates. This is what drives progress. On the other side, maintenance capex sustains the status quo, necessary but non-expansive. Examples: healthcare spending, government jobs, home repairs, essential infrastructure upkeep. Low sensitivity to interest rates. Important, but doesn't propel us forward. Right, let's shift gears slightly and talk about the tariff shock. And this is another really compelling piece of the puzzle, isn't it? These broad-based tariffs implemented in 2025, they've pushed effective tariff rates way up, historically high, projected between 17% and 30%. What's their actual impact?
Yeah, it's important to keep reiterating. Tariffs are, at their core, a tax on imported goods. This directly increases the price of foreign products, sure. But it's generally seen as a one-time adjustment to the price level, not a recurring inflationary pressure that keeps pushing prices up month after month. And while some of the costs might be absorbed elsewhere in the supply chain, studies of recent U.S. tariff actions have pretty consistently concluded that the burden of the cost has fallen predominantly on the United States, on businesses and consumers here, not so much on foreign exporters.
And to help quantify that impact, we can look at the nonpartisan Congressional Budget Office, the CBO. They've put out some crucial estimates of the effects, right? What did they find?
Yes, the CBO's June 2025 report details several key findings. First, the impact on GDP. They project that the tariffs, plus any expected retaliation, will actually reduce real U.S. GDP by about 0.6% by the year 2035. That's due to higher prices, lower purchasing power, business uncertainty, disrupted supply chains, and reduced demand for U.S. exports. So long-term drag. Second, the impact on inflation. The CBO really quantifies the temporary nature of the price shock. They estimate tariffs will boost the annual inflation rate by an average of 0.4 percentage points in 2025 and 2026. But crucially, they state, quote, thereafter, the tariffs will not have additional significant effects on prices, so it fades out. And third, the impact on households. The CBO notes these tariffs function like a large regressive tax increase. They estimate the total cost to U.S. households is around $4,000 annually, with lower-income households seeing the biggest hit to their purchasing power. And it inflicts particular pain on sectors that rely heavily on imported parts, think automobiles, electronics, apparel. So if we connect this back to the bigger picture, the CBO data gives us quantitative proof. You've got the specific front-loaded inflation above 0.4 percentage points that quickly fades, and that's set against the long-term structural drag on GDP of 0.6%. For you, this means the Fed fighting that temporary inflation bump with high rates is actively making the permanent damage to real economic growth worse. This policy focus feels myopic. It prioritizes a short-term, self-correcting price adjustment at the expense of long-term economic vitality, and that seems to contradict the Fed's mandate to support maximum employment. A rate cut here, based on the CBO analysis alone, seems not just advisable, but necessary.
So, given that disconnect, what happens when we look at the actual engines of economic growth? Are they firing on all cylinders, or are they struggling under the weight of these high rates? The report argues the true health of the growth economy is best measured by its most interest rate sensitive sectors, housing and private sector labor. And in July 2025, these two critical engines, well, they're not just slowing, they seem to be stalling.
Let's dive into Part A, the housing market hibernation. This market alone, remember, accounts for a huge chunk of GDP, 16–18%. And it's in a deep freeze right now. It seems like a direct consequence of restrictive monetary policy. Mortgage rates are hovering near 6.75%. That pushes homeownership out of reach for many and locks existing homeowners into their current properties, the so-called lock-in effect. Existing home sales as of May 2025 were crawling along at just 4.03 million annually. That's a huge deficit, over 1.2 million transactions below the pre-pandemic pace of maybe 5.2 to 5.8 million sales.
Wow. So if you're, say, a young couple trying to buy your first home right now, it sounds like you're essentially locked out unless you've got a really high income or significant savings. Is that fair?
That's absolutely fair. It's a brutal market for first-time buyers and even for move-up buyers. And the pain extends beyond just the buyers. Home builder confidence, there's a measure called the NAHB Wells Fargo HMI. It was at just 33 in July 2025. Anything below 50 means more builders view conditions as poor than good. So 33 signals deep pessimism, really recessionary territory for housing, near its 2012 lows. And the slowdown has that negative ripple effect we talked about. Less commission for real estate agents, mortgage originators. And critically, it means a significant loss of that growth capex, spending by new homeowners, furniture, appliances, landscaping renovations. That is jobs in construction, manufacturing, retail. It's a broad impact.
Okay, now let's turn to Part B, the labor market's maintenance-driven mirage. Because on the surface, the labor market looks strong, doesn't it? The June 2025 jobs report showed a headline gain of, 147,000 non-farm payroll jobs, unemployment stable at 4.1%. But applying our maintenance versus growth framework to these numbers, it seems to reveal a deeply concerning trend underneath.
Yes, what's truly striking when you slice the June job numbers using this framework is that the apparent strength is almost entirely, well, a mirage. Out of those 147,000 new jobs, nearly half, 73,000, were in the public sector, government jobs, quintessential maintenance, and in the private sector, which added a total of 74,000 jobs. A whopping 58,000 of those were in rate-insensitive maintenance areas. Healthcare added 39,000, social assistance added 19,000. Together, that's 58,000 jobs.
Wait, hang on. So out of 74,000 private sector jobs, 58,000 were maintenance. That means the entire growth-driving portion of the private economy created how many net new jobs in June?
Just 16,000. 16,000 net new jobs. It's a tiny sliver. And the weakness in key growth sectors confirms this diagnosis. Manufacturing actually shed 7,000 jobs. Construction added only 15,000, which barely keeps pace with people leaving the industry. It's certainly not enough to drive expansion. So what does this all mean for you? The labor market's growth engine is clearly stalling. The headline stability is largely an illusion, propped up by government hiring and those necessary but non-productive healthcare and social assistance jobs. This underlying weakness provides direct quantitative support for Governor Waller's warning about those increased downside risks to the labor market. You can see a dangerous feedback loop forming. High rates slow housing, which reduces demand for growth-related jobs and goods, which then dampens the consumer confidence needed to buy homes. These data sets, viewed through the maintenance growth lens, aren't just weak signals. They paint a powerful, unified picture of a growth recession being actively engineered by policy.
And just looking at those raw numbers from June 2025 makes it stark. Total non-farm payrolls up 147,000. Okay, but government jobs, 73,000 of that. That leaves the total private sector at 74,000. But then, break that down. Private maintenance jobs, mostly healthcare and social assistance, account for 58,000. Leaving private growth jobs, the engine, at a mere 16,000 net new jobs. It really paints a dramatically different picture than just the headline number. So, okay, we've dissected the inflation mirage, the stalling growth engines in housing and labor. But there's another, maybe quieter force at play that I'm curious about. Everyone's talking about artificial intelligence, AI. How does this massive technological shift and all the investment pouring into it factor into this whole economic picture? Is it inflationary, deflationary?
That's a crucial question, and it acts as a powerful, often overlooked counterforce to inflation. While the Fed seems focused on these visible short-term inflation drivers, there's this powerful, less visible force rapidly reshaping the economy. We're talking about the rapid acceleration of AI and other advanced technologies, which are fundamentally unleashing what you could call a structural deflationary wave. Technology, almost by definition, tends to be deflationary over time. It relentlessly drives down costs through efficiency, automation, scalability, and AI represents a quantum leap in this process. Across the economy, especially in the huge services sector, AI is starting to automate administrative tasks, streamline workflows, improve medical diagnostics, enable personalized education, all potentially at a fraction of the traditional cost. This is a deep structural transformation, not just some cyclical trend.
And this tech revolution is being fueled by an absolutely unprecedented wave of capital, right? Global AI investment is projected to surge, approaching $200 billion by 2025. That's a massive injection of growth capex into the economy.
Exactly. And the macroeconomic impact of this investment is still being debated, naturally. But there's a broad consensus that it will significantly boost productivity over time. The debate is really about the magnitude and timing. The optimistic view, say from analysts at Goldman Sachs, projects AI could boost global labor productivity by more than 1 percentage point annually in the decade after widespread adoption. For the U.S., they forecast a measurable impact on GDP starting around 2027, potentially adding about 0.4 percentage points to annual GDP growth by the late 2020s. A more modest view, maybe from someone like MIT economist Darren Acemoglu, still predicts a non-trivial boost, maybe around 1% cumulatively to U.S. GDP over the next 10 years. Still significant. So if we connect this to the bigger picture, this structural deflationary trend from AI and related tech is critical, but seems largely overlooked in the current policy debate. It acts as a powerful tailwind against inflation, a long-term anchor. This potentially gives the Federal Reserve significant room to maneuver, more than they might realize. The Fed's intense focus on those transitory, backward-looking drivers like tariffs, and its struggles with flawed metrics like healthcare inflation, might be causing it to systematically underestimate this massive forward-looking structural force.
This really highlights a profound temporal mismatch, doesn't it? You've got the Fed's policy cycle measured in months and quarters, guided by noisy monthly data. Then you have the inflationary shock from tariffs, which the CBO says is short-term, maybe 1 to 2 years. And contrasting that is the deflationary impact of AI, a multi-decade structural trend with productivity gains compounding over 10 years or more.
It really does sound like the Fed might be mistaking a temporary squall for a permanent change in the climate, as the saying goes, making policy based on the rearview mirror.
Precisely. By prioritizing noisy short-term inflation data over this long-term, powerful deflationary signal from technology, the Fed risks misjudging the true underlying economic currents. This failure could mean the true neutral interest rate is actually lower than they estimate. And holding rates high is effectively fighting against a beneficial productivity-enhancing evolution that maybe should be embraced, or at least not actively stifled. Okay, so let's try to synthesize everything we've talked about. It's complex, definitely, but the economic landscape of July 2025 seems much clearer when viewed through this structural lens, this maintenance versus growth framework.
I think the diagnosis becomes quite clear. The U.S. economy isn't suffering from broad-based, demand-driven overheating right now. Instead, it's experiencing this great disconnect we've been talking about. The rate-insensitive maintenance economy, driven by healthcare, government activity, is creating statistical noise in the inflation and jobs data. And that noise is masking acute weakness in the rate-sensitive growth economy, housing, business investment, productive private sector jobs. The Fed's restrictive policy is like using a sledgehammer. It's ineffective against the structural inflation drivers like tariffs and measured healthcare costs, but it's severely damaging those critical growth sectors. And at the same time, policymakers seem to be underestimating AI's powerful structural deflationary wave that's building.
So what does this all mean for you listening? What's the final verdict from our deep dive into this report's analysis?
Well, the comprehensive case for a rate cut seems rooted in this deep structural understanding of the 2025 economy. Governor Waller's arguments, when you lay them out, appear as a clear-eyed recognition of this underlying reality. The overwhelming evidence when you look at the deconstructed labor reports, the CBO's definitive tariff analysis, the frankly dire housing market data, and apply this maintenance versus growth framework, it all points strongly towards policy being too tight.
And the recommendation then, based on that analysis,
an immediate 25 basis point reduction in the federal funds rate isn't just warranted, the report argues it's essential. This would be a prudent and necessary recalibration. It acknowledges the changed nature of inflation, the clear shift in risks towards the downside for growth and employment. And crucially, it recognizes that the cost of inaction, potentially tipping the economy into a self-inflicted recession that destroys productive capacity and jobs, seems far greater now than the risk of slightly overshooting the inflation target in the short term, especially with deflationary forces like AI at play. Aligning monetary policy with the true state of the economy, the argument goes, is the only responsible path forward to support those flagging growth sectors and ensure a sustainable, non-inflationary expansion for you.
Well, thank you for joining us on this deep dive into the U.S. economy, the Federal Reserve's tricky dilemma, and these powerful, often unseen forces at play. We've seen how what appears stable on the surface can mask some pretty profound structural challenges, and how simply understanding different types of economic activity can change the entire picture.
Absolutely. This deep dive really highlights that economic policy isn't just about hitting headline numbers. It's about understanding the underlying currents, the structure, and how our actions today genuinely shape the productivity and prosperity of tomorrow.
And maybe this raises an important final question for you to think about. Considering this maintenance versus growth framework we've discussed, how do you think an economy can truly thrive when its core growth engines seem to be sputtering? And perhaps what specific data points might you look for next month or next quarter to either confirm or maybe challenge this perspective? Something to chew on as you continue your own deep dives into the world?